Target, one of the biggest retail corporations in America, just issued a very concerning earnings report. In this earnings report, Target reported they saw a big drop in customer visits and a big drop in sales. With Target earnings missing the mark as inflation-battered shoppers avoided buying things they don't really need. With same-store sales at Target down 3.7% year over year and by almost 5% in its physical stores. A signal that US consumers are finally starting to crack in this economy in 2024. Because Target, it's a big retailer, everyone. They have almost 2,000 locations and a market capitalization above 60 billion. They're a bellwether of the health of the US economy and consumer. And so when Target is struggling and when their stock price tanks by 13% in a month, you better pay attention. With Target's executive vice president, Christina Harrington, suggesting that the sustained levels of elevated prices in the economy and inflation have had a meaningful impact on customer budgets and savings for families. Currently, 1 in 3 Americans has maxed out or is nearing the limit of one of their credit cards. For these reasons and more, we remain cautious at Target in our near-term growth outlook. Notably, we expect discretionary trends will continue to remain pressured in the short term. And this is a great point, everyone. It's the fact that the inflation and higher prices of the last 3 years are still a big problem in today's economy. And that just because we're seeing the rate of inflation improve compared to what it was 2 years ago doesn't mean that Americans feel more confident. To the contrary, everything still seems really, really expensive. With Americans continuing to report unfavorable news about higher prices, according to the University of Michigan Sentiment Survey, you can see while there's been an improvement in Americans hearing unfavorable news about higher prices, this is still at a very high historical rate, indicating that inflation is still on Americans' minds. However, folks, I want you to pay attention to this next graph even more. This next graph compares US consumer sentiment to how people get their news on the economy. And in particular, I want you to pay attention to the bottom left of this graph. The people who get their news on the economy from personal experiences have by far the lowest sentiment. They actually think that the economy is in a recession or depression right now if you're deriving your news on the economy from personal experiences. Moreover, those deriving news from word of mouth also have a negative perception of the economy, have low consumer sentiment. Conversely, those who get their news on the economy from mainstream and business news, they actually have very positive consumer sentiment. They think that things are going really well. And that to me is a crazy conclusion and a crazy graph. Because what that graph suggests is that things are much worse in the underlying economy than what is being reported on. I want you all to think about that. When the University of Michigan, in this 70-year-old consumer sentiment survey, asked people how they feel, those reporting based on personal experiences say we're in a recession or depression, feel like we're in a recession or depression, whereas those who get their economic insight from mainstream news think that we're in an expansion. And you have to ask the question, who's actually right about the economy? Because we have this big divergence based on where people are getting their information. And really, everyone, it all comes down to the consumer. If you're someone trying to understand where the economy is going in the future, if you're a home buyer, if you're a stock investor, if you're just someone who wants to understand what's going on, look at the US consumer. Look at how the US consumer is feeling and look at how they're spending. And those trends, they're heading in the wrong direction right now. Because not only is it a company like Target that's having issues, there's been a slew of other big retail companies in the last month that have all reported big problems. They include Starbucks, who had a big drop in sales. Lowe's, who had a big drop in sales. Home Depot, who had another soft quarter. They're showing signs of a consumer pullback. Peloton, whose CEO just stepped down and who's laying off 15% of their staff. And McDonald's, who is now having to resort to a $5 value meal option that's going to lose money for its franchisees in order to get customers back. And so you have America's biggest brands in unison in the first and second quarter of 2024 reporting big issues on the US consumer. So what does that say about the future of the economy? Well, it suggests that there's going to be problems ahead because 70% of our GDP, 70% of our economy comes from consumer spending. And so if consumers are now spending less at these big retailers, and if their credit card debt is spiking and their credit card default rate is spiking, it suggests that spending is going to slow more into the future and that we're going to see more of these revenue misses by companies in the future, and that eventually maybe there'll be some layoffs and the stock prices are going to go down. And this is something now that like even the Federal Reserve is catching on to. Even the Federal Reserve and their associate banks are starting to report on these issues with the consumer. Just take a look at this report that the Federal Reserve Bank of St. Louis just released. They just released a report calling out the broad continuing rise in U.S. credit card debt and delinquency. Again, folks, this is from the Federal Reserve Bank of St. Louis. And they did an analysis on the percentage of people with delinquent credit card debt going back the last 25 years. And they actually broke it out by the wealth of the zip codes that these people live in. And what you can see is that for people in the poorest 10% of zip codes, their credit card delinquency rate is now up to over 15%, approaching 20%, close to the highest rate in the last 25 years. Meanwhile, for the US average, the blue line as a whole, you can see the percentage of people with delinquent credit card debt is now over 10%, which is again close to the highest rate we've seen in the last 25 years, even higher than it was before '08. And then they also do this analysis for people that live in the richest 10% of zip codes. And you can see, yes, the credit card default rate is way lower for those who live in the richest 10% of zip codes, but even so, it's still rising and rising fast, now at the highest level since 2010. And so across all segments and all geographies of the economy, credit card delinquency is skyrocketing. And ultimately, this isn't like rocket science, everyone. Like credit card delinquency skyrocketing. What is that a signal of? It's a signal that consumers cannot afford to live in today's economy, and that the price levels are too high, and that even though the job market is still showing some semblance of resiliency, like we haven't seen a major crush of layoffs and a huge spike in unemployment yet, even though that hasn't happened, it's still problematic to live in America and to afford the day-to-day life in America. And that's ultimately what's actually kind of scary about the situation, everyone, is that consumers are already cracking with a relatively strong labor market, or with a labor market that at least hasn't crashed. So you have to ask yourself the question, what's this going to look like when the labor market inevitably does crash? Like when these missed earnings reports by Target and Starbucks and these companies end up resulting in layoffs. Well, then, I mean, the credit card debt and the delinquency rates and the foreclosures and the mortgage defaults and the evictions, I mean, they have the potential to skyrocket out of control. But now, folks, here's what's interesting is that despite the overall problems the US consumer is having, not every company this earnings season reported a bad earnings report. In fact, we saw Target's main rival, Walmart, just actually have a very strong earnings report, with Walmart opening 2024 with strong sales aided by, interestingly, upper income shoppers, with Walmart, the largest retailer in the US, reporting growth in sales and profit in the first quarter. They saw their comparable store sales in the US increase 3.8% from a year earlier. Now, Walmart saw a 3.8% gain, Target saw a 3.7% loss. So that's a big difference. In relative terms, there was about a 7% differential in how Walmart and Target did on same-store sales. So Walmart kind of ate Target's lunch this quarter, and one of the reasons why actually was that its e-commerce business jumped 22%. So Walmart is doing more and more of their sales online. Additionally, another interesting difference to note between Target and Walmart is the composition of their sales, and the fact that Walmart has essentially morphed itself into a giant grocery store. Like 25 years ago, Walmart barely did groceries. They were very similar to like the way Target is today, 25 years ago. Well, now Walmart's business is heavily predicated on groceries, with about 60% of its sales coming from groceries, comparing to only 20% of Target's sales coming from groceries. And so what Walmart is doing, folks, is that they're still offering fairly affordable prices on their groceries compared to other options. So people are coming to Walmart now, particularly maybe more middle income and higher income people who are feeling strapped, and they're buying their groceries at Walmart. Meanwhile, Target, they don't enjoy that same benefit. They're still mainly a discretionary based store that gets 80% of its sales from more discretionary items, which of course is problematic when consumers are pulling back. And interestingly, everyone, I actually asked you guys on my channel, which do you prefer, Walmart or Target, and why? And after 6,200 votes, 56% of you prefer Walmart, 44% of you prefer Target, and there was actually almost 400 comments on this poll. A lot of them are very interesting. Some people saying that Target has gotten way too expensive. They don't like it there anymore. Some people say neither. Other people are saying they like Walmart because it has everything someone would need all in one place. Another person says, fortunately, I have HEB and avoid both. They must live in Texas. Another person says there's better prices at Walmart. Another person says they bailed on Target when they banned the Salvation Army bell ringers at Christmas. Can't even remember how long ago that was. The broader takeaway here, folks, is this. Is that we have big consumer companies like Target and Starbucks and Lowe's and Home Depot all reporting issues with the US consumer in the first quarter of 2024 at the same time that we're seeing massive stress show up with credit card delinquencies and credit card defaults. That combination should tell you that the US economy is starting to slow and slow big time, and that the US consumer could be on the verge of severely cutting back their spending over the next 3 to 6 months. And if that happens, it will be a big problem for the economy, lower GDP, lower stock prices, lower home prices. Of course, we don't know for sure if that's going to happen. I'm going to track all of the data here on this channel for you guys. So if you like this content and want to see more of it going forward, 2 to 3 videos a week on the US economy and housing market, hit the subscribe button and make sure to turn on those notifications and leave a comment below. What do you think about Target? What do you think about Walmart? Let me hear your thoughts.